Hey guys, this year I've been making video after video about how Ulta Beauty is an undervalued stock. And I put my money where my mouth is, investing around £10,000 of my own money into the company even as the stock price continued to plummet. But after their recent earnings beat, the stock price is finally spiking and I'm back in the green. So do I think that the stock is still undervalued? Well, today let's go through their earnings report and other news surrounding the company, and I'll let you know what I think the fair value is.
We're going to take a closer look at three movers. First up is ULTA. The stock gained about 12% earlier in the session after the beauty products retailer reported third quarter earnings that beat analysts' expectations. But that stock is year to date up about 1%, basically flat.
ULTA proved analysts wrong by showing that the American consumer still has strength. And even though the top and bottom line numbers were a beat on expectations, when you actually examine the figures a bit more closely, you can see that despite a 6.4% increase in revenue, earnings per share actually went down year on year by around 5%. So what caused this huge fall in margins?
While promotional activity continues to normalize, the overall financial impact remains meaningfully below 2019 levels. Inventory shrink continued to be a headwind.
So to summarize, there have been a number of factors that have contributed to margin shrink this quarter, but one of the main ones is an increase in promotional activity. This has been done to encourage more consumers to come to Ulta stores and obviously is a response to slowing consumer spending in general. This is something that can't really be avoided, but at least the one positive that you can take is that the promotional activity is not back to pre-pandemic levels. Ulta also again mentioned shrinkage as another reason for declining margins this quarter, and that's broadly in line with industry standards. It's a problem for most retailers at the moment. And we previously spoken about this problem on this channel, and there have been questions raised as to how much product has actually been stolen from retailers and how much those numbers can actually be impacting the bottom line when they're not that much in the broader scheme of things. But personally, I think that the secondary effects of this kind of theft is actually probably more of an impact on the business, and they might not be seen in the underlying numbers themselves. Just look at the fact that Ulta is having to train thousands of its staff in anti-theft measures, and this is probably very expensive. It's also having to fit many of its stores with locked cabinets for a lot of its goods. And this is undoubtedly reducing consumer spending, although you might not necessarily see it in the earnings figures themselves. One potential clue for this in Ulta's recent earnings are that total transactions in its stores increased by around 8%, but the average transaction decreased by around 1.4%. That indicates that people are buying less things in their trips to an Ulta store. And I wouldn't be surprised if the reason for this is because there are so many locked up cabinets, and when people are walking down aisles, they would usually pick up a thing or two from them, but now because of them being locked and it being an absolute hassle to get someone over to unlock it, they're not buying as many things when they go in to purchase their original intention. Lastly, the company raised salaries for a lot of its employees and had to spend money on remodeling some of its older stores. So these expenses are in general probably just one-offs, and I do think that the margin will recover in future quarters. Another piece of interesting information from the earnings was that the company continued to buy back shares at a prodigious rate. It actually went into its revolving credit loan facility in order to borrow more money so that it can buy more shares back. Ulta barely has any leverage anyway, it barely has any debt, so I do think that the small amount of debt taken out by the company in order to buy back shares was a really smart decision, especially when the share price is so low as it has been over the last quarter or so. This represents really good value for money for shareholders. And personally, I think it really demonstrates the power of share buybacks versus dividends when it comes to capital allocation if a company has excellent capital allocators in its financial department, as is the case with Ulta Beauty. The company has been ramping up its stock buybacks over the last few years to around 5% per year for the last 2 years. And that's while the company's been sitting at a very low historical price to earnings ratio. So I do think it's a really good use of capital allocation. But it is worth noting that the company's CFO, Scott Setterson, is stepping down and will be replaced by Paula Oyobo. So I really hope that this efficient use of capital continues into the future, and I hope that the transition is seamless. If I had to mention one of my main disappointments with this earnings report, it's that they didn't mention international expansion at all. Personally, I believe that international expansion is one of the only ways that ULTA can maintain its historically high levels of growth. We can already see that the number of stores in the US is starting to be saturated. The company currently has around 1,380 stores in the US and is targeting a final kind of peak number of around 1,500 to 1,700 stores. So there's potential for around 20% more ULTA stores within the US. But when you actually look at the numbers for the growth rates for a new store versus a pre-existing store, they're obviously vastly different. A new store will have much higher growth rates than an already existing store. In fact, the company is targeting around 3 to 5% revenue growth for comparable sales in already existing stores. And taken as a whole, if the company was to max out at, let's say, 1,700 stores and then have a total revenue growth of 3 to 5%, that is a lot less than what I'd be looking for in a company that I'd be investing in. We can also see that Dave Kimball in the earnings call has mentioned that oversaturation of ULTA stores has driven down sales at some locations, and they're also facing prestige loss potentially because of this oversaturation, which is a little bit worrying. In fact, when you actually look at the Piper Sandler Taking Stock with Teens survey from the fall of this year, you can actually see that in the beauty category for teens, Ulta Beauty has been dethroned by its arch nemesis, Sephora. Sephora has gained a large percentage of market share and is now at number 1. Sephora has lots of stores abroad and has a much lower saturation in the US, so I could definitely see that the oversaturation of Ulta stores is contributing to the loss of its brand value versus Sephora. Now, it's not catastrophic, but I do think that Ulta has a lot to learn from Sephora here, especially when it comes to international expansion. I think that they should announce this sooner rather than later, but with a new CFO coming in soon, I don't think that they'll be looking to do that until she at least settles in personally. Based on the recent earnings report, I wanted to do another discounted cash flow analysis of ULTA for you guys. So if you don't know what that is, it's effectively a way of measuring what the current fair value price of ULTA shares are based on some numbers and assumptions that you plug in. Bear in mind that those assumptions and numbers are just assumptions, so it's not guaranteed. So here I've put a discount rate of 10%, which is the historical rate of return of the S&P 500 and what you would receive where you just put the money in the market instead of an individual stock. I put my revenue growth rate assumption at 6.5%, which is a little bit above what the same store sales growth rate potential is of 3 to 5%. So I've done 5% plus an extra 1.5% to account for the additional stores that ULTA is aiming to build within the next few years. I think that's achievable, so I'll leave it as that for now. But obviously, if ULTA were to do international expansion, that could potentially expand to something much larger. I've put an EBITDA margin of 17%, which is around the historical level. And I've put a CapEx margin of 3.9%, which is also the historical level. So by using those numbers, we can see that ULTA is currently undervalued by around 4%. The current price is $472 per share at the time of filming, and the fair value is around $488 per share. So it's basically at fair value. If we are to put in some more negative assumptions, let's say, for example, there's only 5% revenue growth. Let's see what the number is. So the fair value is around 432 if you put in 5% revenue growth. So it is a little bit overvalued if that's the case, but I do think that's extremely pessimistic. If I am to increase the revenue growth rate, assuming some level of international expansion, let's say to 9%, then we can see that ULTA is significantly undervalued. The fair value would be $599 per share. So my overall thoughts on ULTA are that it's not particularly undervalued anymore or overvalued. I think it's sitting close to fair value. And with 10% growth baked in, I do think that this is a decent hold for the future. I probably won't be buying any more shares in the company as it's already now my second largest position, and I'd rather concentrate some risk into other companies. So overall, I do think that it was a decent earnings report, and the only thing that was missing for me was news about international expansion. Let me know what you guys think about ULTA in the comments below, and I'll see you guys next time. Leave me a like and subscribe if you did make it this far, please.